Warren Buffett, the GOAT himself, he spoke on many different subjects yesterday. I want to go ahead and focus just on him in this video here today. We're going to react to 4 core videos. First one up here, Warren Buffett explains why Berkshire reduced its Big Apple stake. So they sold about 13% of the shares of Apple, which is something I thought they were going to do, and sure enough, they did it. So we'll go ahead and discuss that, react to that one. Warren Buffett says Greg Abel will make Berkshire's investing decisions when he's gone, and talks about the process of doing that. That should be interesting. Warren Buffett on an acquisition strategy. We haven't seen anything that moves the needle. I'm looking forward to reacting to that one, getting to that one here. And then Warren Buffett on the risk from Tesla self-driving tech to Berkshire's insurance businesses. That should be a very interesting one to get into. Appreciate y'all joining me as always. We got a bunch to get into. Thumbs up. That's all I ask in return. Hit that like button. Make sure you're subscribed, folks. Pin comment down there today. I'll put my Instagram and my X, formerly known as Twitter, if you want to follow me on either of those, okay? Alrighty, guys, let's get into this.
Just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's 2 long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would, but we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that...
Okay, hold on. Got to push back on you, GOAT Buffett, for just a minute here, okay? Mr. Warren Buffett. So, he says, okay, likely Apple's going to be our largest position at the year end. Listen, that doesn't really say much, okay? Apple is such a larger position than anything else Berkshire has that saying this will be the largest position, it doesn't say much. It's kind of like, in the public count, I have a Meta position that's like $800,000+, right? So let's say I sold a bunch of Meta, and then I said, well, it's still going to be my largest position at the end of the year. Well, the next closest position is probably less than a $300,000 position, right? So I could still sell a massive amount more of those shares, and it would still be my largest position, right? And so I just don't think that gives the most confidence about kind of how you're feeling about the stock when it's such an overweight position.
Charlie and I looked at common stocks or marketable equities, or the things that people love to look at, as being businesses. And so when we own a Dairy Queen, or we own whatever it may be, we look at that as a business. And when we own Coca-Cola or American Express or Apple, we look at that as a business. Now, we can buy really wonderful companies in the market as businesses. We can't buy all of them. All of their shares. We can't buy 90% or 80% or anything like that. But when we look at Coca-Cola and American Express and Apple, we look at them as businesses. Now, there's differences in tax factors. There's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business, and we have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many, many years doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business, and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing. And so that made a lot of sense to me then. And the way I've been allowed to deploy it, and Charlie and I talked about this, of course, constantly, it's changed over the years as the amount of capital we have and has changed and all of that. But the basic principle was laid out by Ben Graham in that book, which I picked up for a couple of dollars, and which basically said to me, you've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use. And then Charlie came along and told me how to put it to even better use. And that's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. It's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math or you learn a little more physics. But investments, you don't really have to do that. You really have to have your mind set properly. So we will end up, unless something dramatically happens that really changes capital allocation, a strategy. We will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think.
Thank you.
When I look at the
Okay, there we go. I mean, Buffett, I've heard what he just said there. I've heard that a million times about Intelligent Investor and, how he looks at the market and how Charlie Munger helps. So, somebody that's been studying that man for 15 plus years, I've heard that story a million times. But there we go. We got to the good part. He wants to build his cash position bigger. It's not necessarily Apple's a bad company or anything like that. It's just he wants to build that cash position even bigger, right? So it was kind of a long way of getting there, and I think that gives good value to folks out there that maybe haven't heard that story before, but we finally got to it there. At the end of the day, he looks at Apple stock as an ATM to sell some shares and build that cash position bigger.
Cash position, I think, when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive. And one thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than I think they should. We don't mind paying taxes at Berkshire, and we are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating, and the federal government owns a part of the earnings of the business we make. They don't own the assets, but they own a percentage of the earnings. And they can change that percentage any year. And the percentage that they've decreed currently is 21%. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely, and the government wants to take a greater share of your income or mine or Berkshire's, they can do it. And they may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And we always hope at Berkshire to pay substantial federal income taxes. We think it's appropriate that a country that's been has been as generous to our owners. It's been the place. I was lucky. Berkshire was lucky it was here, and if we send in a check like we did last year, we send in over $5 billion to the U.S. federal government. And if 800 other companies had done the same thing, no other person in the United States would have had to pay a dime of federal taxes, whether income taxes. No Social Security taxes, no estate taxes, no. It's up and down the line. Now, that's. I would like to. I hope things develop well enough with Berkshire that we say we're in the 800 club and maybe even move up a few notches. It doesn't bother me in the least to write that check, and I would really hope with all that America's done for all of you, it shouldn't bother you that we do it. And if I'm doing it at 21% this year and we're doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year.
Boom. Huge. So the reason Buffett sold Apple, and why he might sell more Apple, by the way, he might not be done selling Apple. 1, cash position. 2, my opinion, his view is that corporate taxes will go back up. Now, he might not know whether that's next year or 3 years or 5 years, but it sounds like that man's pretty confident corporate taxes will be going back up, which if you think about it, right, let's say corporate taxes go to 28%. Well, that's another 7 percentage points of tax Berkshire would have to take down the road versus taking now, right? So, and when you want to build your cash position bigger anyways, it's just another extra excuse to, sell some of that position overall. So, and when it comes to taxes, and when it comes to getting tax raises through, I can tell you just logically, it's much easier to get taxes raised on big corporations because people don't have any sympathy for big corporations. Like, oh, good, make those big corporations pay more money, right? That's the viewpoint. When you're talking about if they were to say, okay, let's raise taxes on all of the people that make $75,000 a year, that's a whole different ballgame there. People say, whoa, I make $75,000 a year. No. Raise taxes on the big guy who makes $1 billion a year, right? So that's kind of the thought process there. So, that was actually very, very intriguing. Next one up here. Warren Buffett says Greg Abel will be able to make Berkshire Hathaway's investing decisions when he's gone. This should be interesting.
Question comes from Slaven Vukobrot.
Who?
As CEO, will Mr. Abel be in charge of the portfolio of common stocks that Mr. Buffett has been managing, or will this function be exercised by Mr. Combs and Mr. Weschler?
Yeah.
As investing could be defined as the discipline of relative selection, can major capital allocation decisions such as large acquisitions be separated from the common stock selection process?
Yeah, I would say that decision actually will be made when I'm not around, and I may try and come back and haunt them if they do it differently. But I'm not sure the Ouija board or anything will get that job done. So that job, I'll never know the answer on whether it get covered. But I feel very comfortable about the fact that it will be made by a board that they've got loads of brain power. They've got a dedication to to an unusual institution, and they will figure things out. But I would say that if I were on that board and we're making the decision, I would probably, knowing Greg, I would just leave. I would leave the capital allocation to Greg, and he understands businesses extremely well. And if you understand businesses, you understand common stocks. I mean, if you really know how business works, you are an investment manager. How much you manage, maybe just your own funds or maybe other people. And if you really are primarily interested in...
So that's a phenomenal point Warren Buffett makes right there, right? If you understand business, and this is why I say to a lot of entrepreneur folks, like, you can do common stocks. Like a lot of people think, like, I could never be a stock investor, like, in picking individual stocks. Yes, you could. If you're more of an entrepreneurial type and you understand business and you understand how business works. It's not rocket science to go out there and say, okay, this is a good business. Here's their strengths, weaknesses, opportunities, threats. Go ahead and start running numbers. And then the backside stuff, learn income statements, balance sheets, cash flows. You can do that in no time. Then after that, it's about figuring out valuation and finding out what are really attractively priced stocks, right? And so you can run the numbers on that. I mean, the game is not as crazy as people think. Like, it's amazing how many people can join my private group and within a month already be up to a very high level as far as like understanding more than 99.9% of people about picking stocks. But they make it out to be a lot harder than it is. No, if you don't understand business, you don't understand, you're not maybe an entrepreneurial type. You don't really understand how businesses make money. You've never really been in management, anything like that. That's where it can probably get hard.
In getting assets under management, which is where the money is, you don't really have to understand that sort of thing. But that's not the case with Ted or Todd, obviously. But I think the responsibility ought to be entirely with Greg. The responsibility has been with me, and I farmed out some of it. And I used to think differently about how that would be handled. But I think the responsibility should be that of the CEO, and whatever that CEO decides may be helpful in effectuating that responsibility. That's up to him or her to decide at the time they're running the money. But so I would say that my thinking on that has developed to some extent as the sums have grown so large at Berkshire, and we do not want to try and have 200 people around that are managing $1 billion each. It just doesn't work. I think that when you're handling the sums that we will have, you've got to think very strategically about how to do very big things. And I think Greg is capable of doing that. I think I've missed a lot of stuff in the past, so I'm actually wiser about doing that now. But I would do it better this time around than 2008 and 9 if something akin to that happened. But it won't be exactly like 2008 or 9. You can be sure of that.
Oh, that's interesting. Buffett's actually showing some... Wow. Buffett's actually showing some displeasure with the way he handled 2008, 2009. My guess is he would have been much more aggressive than they were. That's interesting. I've actually never heard him maybe show like a little, almost like remorse about 2008, 2009. That's interesting.
2008 and 9, if something akin to that happened. But it won't be exactly like 2008 or 9. You can be sure of that. But you also can say that there will be times when having huge sums available extremely quickly. Maybe it'll be once every 5 years. Maybe it'll probably be more like once every 10 years or something. But as the world gets more sophisticated, complicated, and intertwined, more can go wrong. And there's no sense going through here and exploring the possibilities of the different things that could happen. But we do want to be able to act when it happens. And I think the chief executive should be somebody that can weigh buying businesses, buying stocks, doing all kinds of things that might come up at a time when nobody else is willing to move. It wasn't that people didn't have money in 2008. It's that they were paralyzed. And we did have the advantage of having some capital and a willingness to, an eagerness even to act, and a government that in effect looked at us as an asset instead of a liability. And I think that all of those qualities will be even more important as our capital pile grows. And so I think Greg may have even more fun than I had in a period when extraordinary things were happening and we were the logic.
By saying he's going to have even more fun than he had, that basically means a lot more money to be made for Berkshire. That's interesting.
Place to go. You never know whether it'll be next week, next year, next decade. But it won't be a century from now, that is for sure. The more intertwined and sophisticated the world financial situation gets, the more vulnerable it gets in a certain sense. It solves a lot of small problems, but it leaves it more vulnerable to large problems.
Interesting.
Greg, does that bother you at all or not?
Without directly answering the question, I think there's one important thing is I think as we go through any transition, it's important to know that the capital allocation principles that Berkshire lives by today will continue to survive, Warren. And I think that's what the thing I'd want to communicate, that we have our operating businesses, insurance, non-insurance. We'll provide them the capital necessary to be successful and grow if it's appropriate. Yep. At the same time, we're expecting a return of capital from them when they have excess cash. And then, as we've discussed, or you've touched on, always looking at potentially new businesses as a whole or in a piece. And as you've always highlighted, and I fully agree, we'll always look at equities as we're investing in a business, either 1% or 100%. But we're looking at the business.
I will be honest with you guys. There's going to be one issue coming for Berkshire Hathaway stock. A big issue, okay? The day Warren Buffett passes on, the valuation premium that people are going to be willing to take for Berkshire Hathaway will start to go down. Whenever you have a truly legendary CEO at the company, when that person's no longer there, people are not willing to pay as much for the stock. It's as simple as that. Are 18,000 people or whatever that showed up for this meeting at Berkshire Hathaway just showing up because Berkshire Hathaway or because Greg Abel's talking? No. They're there for one man. His name's Warren Buffett, okay? And so whenever he's not there anymore, the business valuation will not be able to command the sort of forward PEs, trailing 12-month PEs, and it will slowly erode. Does not mean it goes to zero. It's just people aren't willing to pay as much. And you can look at any business and see that over time, right? People are willing to pay a lot different valuation when Steve Jobs was at Apple versus Tim Cook at Apple, right? People are willing to pay, much less for Wynn Resort stock valuation-wise than when Steve Wynn was there, right? And so this is just something to kind of keep in mind because you don't always have a truly legendary CEO of a company. You have to be like famous, like literally like famous and like so successful that people like an Elon Musk at Tesla, would Tesla command the sort of valuation it does on a forward PE basis or trailing 12-month PE if Elon Musk was not the CEO of Tesla? No, it wouldn't. It commands that because Elon's there. Okay, so this is just things to kind of keep in mind with Berkshire stock whenever that day does arrive.
At the economic prospects of that business and how sustainable it is and what it will look like 10 years from now, and is the capital we originally put in at exponential risk, or where's that risk sit, that profile? And then of course, and then we'll obviously have our continue to always put excess cash in the safest investment there is in U.S. Treasuries, knowing we want to maintain that fortress of a balance sheet for two reasons. One, to act, but also to always protect our shareholders. If we want to maintain the position Berkshire is in now, realistically, to ensure it endures.
Well, when he says that, it makes me wish I'd stayed around to be number 2 instead of number 1 in this process over the years. It doesn't get more fun than what we're doing, and we're better positioned than ever before. We're not positioned, though, however, to earn extraordinary returns versus what American business generally earns. I would hope we could be slightly better, but nobody's going to be dramatically better over the next century. It gets very hard to predict who the winner will be. And if you look back, as we did a few meetings ago, as to the top 20 companies in the world at 10-year intervals, you realize the game isn't quite as easy as it looks. But getting a decent result actually should be reasonably easy if you just don't get talked out of doing what hasn't worked in the past, and don't get carried away with fads, and don't listen to people who have different interests in mind than the interests of our shareholders.
100%. Yeah, good points he made there. I might come back to that in a little bit. Warren Buffett on acquisition strategy.
You talked about selling some of the Apple shares in order to build up your cash supply. And I think it's had a lot of people wondering where you see opportunities or what might be coming or market valuation. So I'll ask this question from Foster Taylor. At the 1999 annual meeting, you mentioned that if you owned all of America's 500 businesses, you would be making $334 billion while paying $10.5 trillion. You emphasized that this was not a good return on investment. Today, by my math, the S&P 500 has a market capitalization of around $44 trillion with profits of around $1.45 trillion. This is a very similar return on investment to the 1999 levels. Do you see similarities in the market today and the 1999 levels?
Good question.
Well, one thing has changed dramatically from 1990. I misunderstood on the 1999, but there have been times in my life that I've been awash in so many opportunities that I could have invested everything by nightfall. And then there's other times when the year goes, well, not in the early days, but now, we haven't seen anything that makes
that rate there was important. That rate there was important. He says not in the early days, and that gives me a great point to make for retail investors. It doesn't matter what market you're in. As a retail investor, you have every stock at your disposal. There's thousands of stocks in the market. You're telling me you can't find a good deal anywhere? No, you can. You can find good deals in places when you have the whole market at your disposal. The problem for Warren Buffett is that he might go into here is they need to invest so much for it to make even logical sense for them to invest in. We're talking minimum of several $billion. So that takes basically, Warren Buffett can't even mess with market caps under 10 billion. Like that, even market caps under 100 billion is getting difficult now at this point in time. So how many companies really have, valuations of market caps over $100 billion? It's a very small amount, very small amount. So And then how many are in Buffett's circle of competence? Also a very small amount, right? And so that's what makes Berkshire's game nowadays so dang difficult versus as he spoke about there in the early days.
That moves the needle. Now, we've made small acquisitions during the year. Our companies have made acquisitions, and we, Greg and I may talk about something that involves a $300 million purchase or something like that. And, if it fits well enough, we do it. But
basically, he's playing it nice, but basically the way he's saying is like not even worth our time. Like a $300 million acquisition, them spending $300 million is like, it's not even worth our time. Like, I guess we'll do it. Like,
our managers see things that fit them. We want to look at them because our managers do not have necessarily the same equations in mind that we do. But there's some managers which we would end up just say, whatever you decide to do, and then there's other managers that would not know how to allocate capital particularly, and that they don't have to be able to be great capital allocators if they happen to be great at serving customers and understand their own industry and all of that. That they can be great managers. A good many of them are capital allocators, and others are. But this is not a time when the phone is going to be ringing often, but there are times and Greg will know how to handle them as well or better than I have over time. And Charlie and I we missed a lot of things, and what we really regretted was missing something that turned out to be very big. We never worried about missing something that we didn't understand. I mean, why should we be able to predict the future of every business any more than we can predict what wheat yields are likely to be in Illinois next year? Well, not wheat in Illinois, wheat in Kansas, but corn in Illinois. I don't really think of whether it's similar to 1999 because I'm not that good on chronology anyway, unless something really dramatic happened at the time. I mean, I remember things from 2008 and 9 much better than I remember whether something happened in 2015 or 1987 or 1987 I remember because of October 19th. I just don't think that way. I just look at what I can do every day. Greg?
I'm going to have to use it. Nothing to add.
Okay, well, we'll go to station 2.
That's awesome. That's awesome. Okay, next one up here. Warren Buffett on the risk from Tesla's full self-driving. This should be interesting.
It's from Jeff Oyster. As a Berkshire and Tesla shareholder, I would like to hear your thoughts on the potential financial effects to Geico, assuming Elon Musk delivers on his fully autonomous driving goal. On Tesla's most recent earnings call, Elon said, if you've got at scale a statistically significant amount of data that shows conclusively that the autonomous car has, let's say, half the accident rate of a human-driven car, I think that's difficult to ignore. Assuming Elon succeeds in reducing accidents by 50% versus human drivers, wouldn't auto insurance rates fall to reflect the reduced underwriting risk, thereby adversely impacting Geico's revenues and float and perhaps margins too?
Well, yeah. Well, let's just take the extreme example. Let's say there are only going to be 3 accidents in the United States next year for some crazy reason that anything that reduces accidents is going to reduce costs, but that's been harder to do than people have done before. But obviously, if it really happens, the figures will show it, and our data will show it, and the prices will come down. There have been a lot of people talk about doing that in the past. I mean, General Motors used to be very big in the insurance business, and And when Uber first started, they used some firm which now is, I think Ajit will confirm that they're close to bankruptcy now, aren't they, because of taking things on at the wrong prices? Is that true?
Yep.
Yeah. Insurance always looks easier than it is, and it's so much fun because you get the money at the start, and then you find out whether you've done something stupid later on. But it's a very tempting business when somebody hands you money and you hand them a little piece of paper. But really knowing whether if accidents get reduced 50%, it's going to be good for society, and it's going to be bad for insurance companies' volume. But good for society is what we're looking for. So far, you might find kind of interesting. I mean, the number of people killed per 100 million passenger miles driven. I think it actually was when I was young, it was like 15, but even post-World War II, it only fell to like 7 or thereabouts. And Ralph Nader probably has done more for the American consumer than just about anybody in history, because that 7 or 6 has now come down to under 2, and I don't think it would have come down that way without him. There have been some kind of fluke figures of what people did during the pandemic, which are quite interesting, because they didn't drive immediately. They didn't drive as many miles, but they drove more dangerously, didn't they?
Yep.
Is that right, Ajit?
Yeah. So the point I want to make in terms of Tesla and the fact that they feel that because of their technology, the number of accidents do come down, and that is certainly provable. But I think what needs to be factored in as well is the repair cost of each one of these accidents has skyrocketed. So if you multiply the number of accidents times the cost of each accident, I'm not sure that total number has come down as much as Tesla would like us to believe. Tesla has been toying with the idea of writing insurance directly or indirectly, and so far it hasn't really sort of been much of a success. Time will tell, but I think automation just shifts a lot of the expense from the operator to the equipment provider.
Yeah, good point. By the way, Instagram and my X are linked below. Pin comment down there if you want to follow me on either of those platforms. So first off, yeah, you can't ever count out Tesla, right? And so it's clear it's on Berkshire's radar what Tesla's up to there. And I don't see why Tesla can't have a very successful insurance company long term. Are they a threat to Berkshire in the next 3 years? No, not in my opinion. Even the next 5 years? No, not really. In the next 10 years? Now we're really talking, okay? In the next 20 years? Yes. If we're talking about robo-taxi fleets and Tesla insures all those, right? Especially that are on their fleet, and they even are insuring the ones that are external. And they bring down the amount of accidents that happen dramatically, and the amount of deaths and injuries and all those things. All that's a major risk to obviously the insurance business. But that's a lot longer term, right? That's things that we could be talking about 5 years from now, 7 years from now, 10 years from now, 14 years from now. So in terms of actually denting profitability of actual other insurance businesses. So in the short term, I don't think it's really a threat. Long term, it likely is. Now, overall, Warren Buffett, in kind of hearing, the way he was talking and whatnot, I'll say this, okay? He sounds conservative. He sounds like he's comfortable holding a lot of cash, which is clear in the numbers. He sounds like a man that's very happy to be getting what they're getting on treasuries. He sounds like a man that has a lot of trouble finding deals, which is not a new thing. I mean, honestly, he's been speaking about that for years now at this point in time, having trouble finding good deals. I feel like it's been at least 5 years of him talking about that, like trouble spotting something that's really, really attractive. And so I think at the end of the day, I think he's in a hard place right now, because I think he wants to. It's like, you ever played poker and you're like, if you're a smart poker player, you got to wait and pick and choose where you want to play. But let's say you're just getting crap cards, you can't play anything, like you start getting antsy and you start wanting to make a move happen. I feel like there's a little bit of Warren Buffett where he wants to do something, he just can't get good cards to start the hand because of, once again, they have to invest so much money into such a big opportunity, and he's got to be able to understand it, right? And so I think really that's the trouble for Buffett right now, is just really finding those big, attractive risk-reward profiles. You know, you look at something like an Amazon. I think Amazon's a very viable stock, but he has a lot of trouble like really understanding Amazon full across the board into why to buy that stock and pay a premium. You look at a stock like Meta. Like, oh my gosh, Meta for years has been such a perfect buy for Berkshire Hathaway. I mean, I just wish like Buffett really understood Meta and like how sticky the business model is and exactly how they do business, and like, I mean, he would be all over Meta. He would have been buying that stock for the last 10 years and, you know, still adding aggressively. Because if you look at the valuation, the income statement, the balance sheet, and all those things, it's just, but at the end of the day, you know, it's social networks, and, you know, even it's something as simple as Facebook, like Buffett, you know, has trouble like really getting it in Instagram and WhatsApp and how they make money all these different ways. And so it's unfortunate. I do believe that if Warren Buffett was a little more open to other folks, I believe, you know, opinion in regards to some of these stocks, I do believe, you know, he would be deploying money and would have been deploying a lot more money over the past 5-7 years than what they've done. I believe their cash balance would be a lot lower, but I believe Berkshire Hathaway's valuation would be a lot higher. Their profits would be a lot higher, and the percentages of returns they'd be getting on stocks would be a lot higher. But, you know, it's tough sometimes. You know, Buffett's, 90-something years old now at this point in time. And so at some point in time, it's just like, you know, I can't even, it's hard for me to even fathom like being 90-something years old and trying to make investment decisions on businesses that, you know, you just couldn't even have conceived of when you were starting in the game in your late teens or your 20s or your 30s. You know, a lot of this stuff is just like, it's so crazy and different. And understanding artificial intelligence and you know, computers learning and the adoption rates and inference and all these different things. I mean, it's difficult for anybody, never mind somebody in their 90s, to try to learn all those things. And so I think that's just kind of the whole gist of things in regards to that. Buffett sounds pretty conservative. Sounds like a man that wants to do deals, but it's just he has trouble because, you know, it has to be the perfect thing that he can wrap his head around and be like, yes, I get it. Like, I'm going to buy this. So, yeah, that's that, folks. Okay. And by the way, the Berkshire, a perfect hedge for them would be buying Tesla stock. Perfect hedge for them. If Tesla is really successful in really hurting the insurance business, bringing down accidents, the robo-taxi network, the semi and transportation of goods around, which could hurt the railroad system long term. These are more 10, 20, 30-year things that are going to play out, right? You want to own Tesla stock then. Tesla's a perfect hedge. So although I'm sure Buffett would not like the forward P Tesla's trading at to be buying that stock, I think it would be the most brilliant hedge ever for them. Just in case Tesla pulls off a lot of these things they're working on and it does displace some of Berkshire's major businesses, they're hedged because then they get to capitalize on Tesla. Because then Tesla, if they can actually do that, they'd be, you know, obviously a 5, 10, who knows, $20 trillion company or something like that. If they could actually displace many of these massive industries and actually grab crazy big market share in them, right? So I think it would be such a good hedge. And if it doesn't work out, it's not the end of the world for them, because that means, you know, like let's say Tesla fails at robotaxi network. Like I don't know, they just can't figure out self-driving vehicles. They fail at their insurance business. They fail at semis, and the semis driving themselves. And they fail at all these things that they look like they're getting closer and closer to. But let's say they fail at them all. Oh, well, you take a loss in Tesla stock, but it's a very small amount compared to if Tesla actually succeeds, the damage I could do to several of Berkshire's biggest businesses, right? And so it just seems like, to me, it's a very logical hedge on just in case Elon and that team figures out all these things they're working on, you know, hey, you get to capitalize on that. But anyway, that's just my 2 cents on that subject, okay? Appreciate y'all joining me as always. Thanks so much for being here, folks. Much love. Once again, my Instagram, my X, will be pinned comments down there if you want to follow me on those platforms. And have a great day.